Hello, everyone. My guest today is Corey Thomas. He's the CEO of Rapid7 and chairman of its board of directors. He has extensive experience in leading technology companies to the next stage of growth and innovation. Before Rapid7, he worked with Microsoft and Deloitte. He graduated from Vanderbilt University and had his MBA from Harvard Business. Again, now building Rapid7, playing in the security analytics and automation space. Corey, you ready to take us to the top?
Absolutely. Glad to be here chatting with you.
All right, man. All right. So tell us about Rapid7. What's the company do, and are you a pure play SaaS model?
We're a pure play SaaS model. We're in the security analytics and automation market. At the core, we actually help people understand what's happening in their environment from a security perspective using a massive data collection engine and figure out, are they vulnerable? Are they compromised? And if so, helping them quickly remediate those issues.
And are you kind of a Malwarebytes bottoms up model where you're selling $6 a month plans to employees, and then before you know it, the CTO is buying a big enterprise license, or are you going kind of top down, you know what I mean?
Yeah, no, absolutely. So we sell to teams within an organization. So it's typically much larger transactions than having sort of like a couple dollars a month. All of our revenue is recurring based revenue, but most of our deals actually come from selling to fairly large teams within enterprises.
Okay. So if someone's listening right now and they're looking for such a platform like yours, on average, what's the customer going to pay you per year to use your platform?
Yeah, so we make it really easy to get started. So customers can get started, in the tens of thousands of dollars range. And then we, of course, have customers that go up to the millions of dollars per year range. But we try to make it as easy as possible for people to actually start building out their security program.
Okay, so I mean, would it be fair to say someone, a team size of, call it, 30, 40 people is going to maybe pay $50,000 a year or something like that to get going?
That's it. That's it. Started. And what you find is we actually have 4 core sets of products: vulnerability management, incident detection and response in SIEM, application security, and our last one is the security automation and orchestration. And so that $20,000 to $50,000 is typically sort of for one team, one of those projects. And as they deploy more projects to cover more of their environment, it's more.
Corey, can I ask you, one of the key things to any SaaS company expanding rapidly is obviously driving expansion revenue year over year. It sounds like you are nicely set up to drive expansion revenue with multi-product lines, probably a multi-seat approach, and some probably usage-based metric as well. So an account that starts with you, let's just make the math easy, at $50,000 per year, typically from year 1 to year 2, how much will you expand them by? You'll double them or triple them or what?
Yeah, so our expansion rate is roughly 120% on a year-over-year basis. So we focus on life study expansion over time, and that's really our view. The thing I love about the SaaS model is you don't pre-buy; like, it's based on your usage. And so if you think about what the inherent bottleneck in security is right now, it's that people have to staff up their teams, they have to have capacity, we drive productivity, but they actually pay more and buy more as they actually are getting more value and more usage.
Yep. So a cohort that signs up with you a year ago, you're saying you'll expand that cohort on average by 120%. That means you have expansion and churn built in there. So what do you see if you peel back, ignore expansion for a second, your gross churn on a revenue basis annually? Are you kind of sub 10% in the healthy stages, or are you more or less?
Yeah, no. So it is in the healthy stage. The thing that we've reported publicly, retention rate is 90% the last time that we actually quoted our expiring revenue retention rate. And really, that's a mix of 2 things: is mid-market customers, which actually, as you can imagine, have higher churn rates.
Corey, real quick, sorry, you cut out. What was that 90% number? That's your net revenue retention or your gross retention?
No, that's the expiring. So we have 2 sort of like renewal rates. One is the expiring renewal rate. Deals that are up this year, and so like how many customers stay from a dollar perspective, that's 90%. If you look at our overall renewal rate, it includes upsells and cross-sells, that's 120%. And so I'll say the 90% is a mix of some smaller customers that actually have slightly higher churn rates, and then larger enterprise customers that have more established programs that actually have a much, much higher retention rate.
Yep. So just repeat that back to you to make sure I got it. 90% stay, or said differently, 10% of your revenue churns annually, but you expand that same cohort by 30%. So your net revenue retention is 120.
Yep, you got it, 30%.
Perfect. Amazing. All right, let's put this back on a timeline. I want to get the backstory here. When did you launch the company? What year?
So the company was actually founded in 2000. I joined the company as the head of operations in 2008. And I became the CEO in 2012.
Okay, 2012. Now, was this part of a round of funding and a VC said, we want Corey leading, otherwise you're not getting our money, or what? How'd you come in as CEO?
Yeah, so I joined in when Bain originally, I joined when Bain Capital Ventures did the initial investment. and I joined as the head of operations. And then subsequently, as the company was plotting out its next stage of growth, they asked me to become the CEO.
Okay. So how much raised so far?
Yeah. Oh, so we're public today.
Yep.
And so before we had actually gone public, we had raised a little under $100 million, so around $90 million. And then we've done a couple of different public raises and some subsequent raises after we became public.
Remind me again, sorry, what year did you guys IPO?
2015.
2015. Okay, so you had joined, I guess you were there for what, 4 or 5 years before the IPO?
I joined in 2008.
Yep.
And yeah, exactly. So I joined in 2008, and then we went public a little bit later. Yep.
So walk me through that transition, because there's a lot of companies that, the founder is not, or the one that goes from 0 to 1 is not the right guy to also, or gal to take it public, right? So what's the relationship like with the actual original founders? Were they supportive of this move? Was it more hostile? How did it work?
Incredibly supportive. I mean, the one thing that I actually learned is Alan Matthews and Tosh Giaconakis and a guy named Chad Loader, who was the founding team. They had this great model of what, in retrospect, I thought about as sort of like stewardship. And they were saying like their core purpose is the mission of the organization. So our core purpose was, how do we actually take the complexity out of security? So how do we simplify security overall through analytics and automation? And their whole mission was that, listen, you need the right people in the right jobs at the right time. And so when they made me CEO, Alan became chairman. Taz is still here as our CTO. And then Chad went on to go start another set of ventures. But when I became CEO, Alan's feedback to me was just like, hey, take the company to the next level, but also have the self-awareness to recognize when you're a steward for a period of time and to actually inhibit the mission. And if you're not supporting the mission, or someone else can do a better job of it, then it's your job to actually find them and help bring them in. And I think that's just such a great mentality about how to think about things.
That's interesting. So you closed out, I believe, 2018 in terms of ARR at somewhere around, I think like 250 million around that. People can look it up, but 250. Yep. But I do remember the growth rate year over year was something like 30% in terms of ARR growth rate year over year. Is that right?
So our ARR growth rate actually ended the year last year over 50%. And
okay.
So we had really accelerated our overall ARR growth rate.
53%.
Yep, exactly.
Let me ask you a question. Being a publicly traded kind of CEO, we've had maybe 7 or 8 others in the SaaS space that are publicly traded. I always like to ask this question. Do you believe public markets understand like deeply what expansion revenue means? And if all your growth over the next 12 months, you didn't add a single new customer, but you grew 53% again year over year, all from expansion, would they value you higher or lower because of that?
It's a good question. It depends on what evolution. I would say public companies and public investors have different levels of sophistication when it actually comes to this. In fact, one of the interesting things for me is that I found different types of investors have different levels of depth in understanding this transition. What I would say for where we are right now, our investors very much are looking for and are invested in Rapid7 because of the expansion capability. And so if you think about what most of our investors are talking about, is they're like, you've actually steadily grown your renewal rates and your retention rates to over 90%, and you're expanding at a quite healthy rate, and you actually have big market opportunity in front of you. So our investors really understand that. The thing I'll tell you, though, is it took a while for us to actually find those investors, and the company was undervalued for a while as we were actually both delivering the proof points around the things that we had talked about, and as we were finding those investors who were actually going to do the homework and understand what was happening.
Yeah. You got almost $100 million on the balance sheet, according to the financial report at the end of December of 2018. KnowBe4, Malwarebytes, these are companies that are getting closer to the 80, 90, 100, if not north already, $100 million ARR marks in the cybersecurity space. Maybe they go public here shortly. If they put out a public announcement they're planning to go public, do you try and move in quickly and take them off market before they list?
No, we're very disciplined. So we do M&A. Most of our acquisitions have been technology tuck-ins, but I have a couple of simple things. One is you should actually have a clear vision and clear direction about what you want to do. You should have some ideas about how you're going to do it, and then we have a set of things that we consider strategic accelerators. And if they actually become available at the right price, then we'll absolutely look at them. But I think it's fair, at least for me, it's undisciplined to actually jump in just because something's actually coming available. That's not saying we won't do it if it's actually highly strategic.
Yep.
But most of the time, if you actually take a longer term perspective, you can find stuff that works.
How many customers have you scaled to today?
Yeah, we are a little bit under 9,000 customers.
Okay, 9,000 customers. The reason, and sorry, what PE ratio are you trading at? Last time you checked, do you remember?
Yeah, it's a little over. So it's not. We trade on a revenue basis.
Yep.
And so it's a little over 7x on a revenue basis last time I checked.
So let me ask you a question. If you came across a deal where the tech made a lot of sense, but really you saw a good deal in the sense that you could get a company, maybe they'd raised $20 million, but they didn't get growth, and you could go, buy them at like a 1x ARR multiple. So there's like essentially a 5x arbitrage there, right? If assuming the transition is smooth. Have any of your past acquisitions followed that strategy where, again, solid tech, slow growth, but ARR arbitrage?
Yes, we didn't think about it as ARR arbitrage, although that's what it was.
Corey, by the way, you would never sell everyone and say, we're going to financially engineer the hell out of it. You would never say that.
Exactly. But, I'll give you an example is that we bought this great application security company that had great tech growth in what we thought it could. We brought it in. We did some minor updates to the technology, made it more cloud-centric, and that thing took off. That's a perfect example where it had been stalling for a bit. Those tend to be smaller deals because what we're really doing is we're actually thinking about buying core great technology, but we believe that we can actually accelerate the growth. So the reason I say is for us, it's not just the arbitrage, is that all of our core tech M&A, when we look at it, it's primarily driven to actually accelerate growth. And so we think about it in terms of like, okay, someone might have been growing it sort of at flat or sort of sub 10%, but what can I do with it? And that sort of like takes, some confidence to actually really understand what your team can do with the asset versus what that asset and what that technology has done by itself.
Yeah. What's your team size today? How many people?
We are a little over 1,300 people in the company.
1,300. And then last question here on economics before we talk more about product and future product kind of story. To get a new customer, right, that's paying you, I'm going to make this up, $50,000 in year one, how aggressive are you willing to be on CAC? Yeah,
so I would say that we are quite willing to actually make an upfront investment, especially if you think about and just to be clear, so our average ARR per customer is around a little over $30,000 per customer. So just to be clear, and so the $50,000 was more based on the customer size that you and I were talking about earlier. The way that we actually think about it is, on average, we have the potential if that same customer was to fully deploy our products, for that $30,000 to actually be $200,000. And we've been steadily growing the ARR per customer over time. And so really the way that we actually think about it is what's the investment we make today and what's the payback period. Now, we haven't published that number, so I can't actually say it publicly,
okay.
Right? And what those rates and what those conversion rates were. But what I would say is that as long as we're seeing healthy expansion, which is the thing you actually brought up earlier, it actually gives us confidence to actually go out and make investments in our customer base.
Don't tell me what's actually occurring in the business, but talk about what you would be comfortable with in the future. I mean, with the analysis you just gave me, right? The confidence and retention, expansion, things like that. Would you be comfortable going up to a 24-month payback period in the future?
Absolutely. If you look at it, is that if you say you have confidence to actually, let's just keep it relatively simple.
Sure.
To triple something over 3 years, would you actually sort of like have a 21-month payback period in an ARR model? Yeah, that's a no-brainer, sort of just from a math perspective. And so that's exactly the type of stuff that we're looking at on an ongoing basis is, how much does it cost to actually keep the customer having a great experience? The one thing I would say that we do slightly differently is that we're not just looking at the retention rate. We're also looking at like, what does it cost for a customer to have a great experience? Because the more customers that are actually recommending us, it actually lowers the CAC in the future. So we're constantly sort of assessing, is the best investment in the upfront acquisition, or is the best investment actually improving the customer experience? And recently, we've actually shifted more of the investment to improving the customer experience because the income and the revenue and our success that actually comes from our customers being happy and successful, it's just worth its weight in gold.
Yeah. One customer turns into two, which then splits your CAC essentially.
Exactly. So, if you look at and we've talked about this publicly, recently we've been much more focused about like how do we actually have customers be phenomenally successful more than just sort of the upfront acquisition cost.
Yep. No, this all makes great sense, Corey. I want to wrap up here with the famous 5. Number 1, what's your favorite business book?
Oh, my favorite business book is, I think it is going, and I'm going to butcher the name because I just made my daughter reread it. It's actually Seth Klarman's book. It's about investing. It's not even in print anymore.
Seth Harmon?
Seth Klarman. He has a book about investing, but he's just a great value investor that helps you think about sort of like how you actually think about value. And if I can do a second one, I would actually say Team of Rivals by Doris Goodwin Kearns, which is actually, while it's not a business book, it actually does talk about the complexities of managing teams when things aren't perfect and they're messy. And I think sometimes what I find with lots of business books is that they teach you how to deal with a simple world. For me at least, the world is quite messy all the time.
Not simple.
So I appreciate books that actually help. Exactly. I appreciate books that actually help me understand complexity.
Number 2, what is it? Is there a CEO you're following or studying right now, Corey?
Yes, I would say one of my mentors is a guy named Aaron Ain, who leads the company Kronos. He just wrote a book himself. But like he just, I get to spend time with him a few times a year. And he's just a phenomenal guy with a deep perspective about how to build a growing business, but also how to actually really think about making great investments in people and developing people and talent.
Yeah. Number 3, is there a favorite online tool you've got for building your company?
Ooh, a favorite online tool. This is going to get me, you're going to get me in lots of trouble with lots of different friends.
Yeah,
now.
pick your best, pick a baby.
Exactly. I'm going to have to. And so I have to tell you, we have offices all over the world, and I am using and loving Zoom quite frequently right now for the ability to actually connect with our team members and our moose. We call them moose all over the world.
There you go. Eric is loving you, even though he thinks they're overpriced right now in the public markets. We'll see what happens there, guys. Number 4, How many hours of sleep you get every night?
I try to get 6. It's typically between 5 and 6.
And what's your situation? Married, single, kiddos?
I am married with kiddos.
How many kids?
2.
2. Okay. And how old are you?
Yeah. I am 43.
Last question. What do you wish your 20-year-old self knew?
20-year-old self?
Yep. Take us back 23 years.
Yeah, Jesus. My 20-year-old self, the one thing that I wish that I knew was to actually, as I made friends, to, keep working hard, do all that stuff, but actually stay in touch. Like, don't lose connections as you actually go along and you get busy with work and family.
Guys, stay in touch with early friends. Coming from Corey, public company Rapid7, playing in the cybersecurity space, north of $240 million in ARR, growing 53% year over year. Again, impressive at those numbers. And the reason is because he's really dialed in expansion revenue, right? 90% retains are then expanding. So 10% churns, but they're expanding by 30%. So 120% net revenue retention as he looks to continue driving that up. Plenty of cash on the balance sheet in terms of M&A. Again, looking at things that make a lot of sense. They've been aggressive in the space already. Maybe some more deals in the future. But in the meantime, Corey, thank you for taking us to the top.
Thank you so much. I've enjoyed it.